In today's episode, I am going to study three companies that I feel will do really well in the next 365 days. Now, as you know, the market is overheated, right? There are a lot of companies that are sitting at extremely high PE ratios. There are some opportunities, but most of them are overvalued. Some very good opportunities are there as well. And I want to look at companies at this point when I'm investing. I should know, Shashank, which company should I invest that is even safe from tomorrow's crash. Now, when a crash happens, or even if there's a small correction that happens, your portfolio might go down by 2-3%. Don't worry, I'm going to look at three companies now that even if it goes down, I would keep doubling down, and I'll show you why as well. Yeah, so let's quickly get into the video. Now, the first company we will look at is a company called Tube Investments. Now, this is one of the most beautiful companies that I've seen. And by the way, guys, none of this is a buy or sell recommendation. And while doing this video, I don't hold any of the stocks that I'm showing you, right? Now, why I like Tube India, I'll tell you, right? Now, this is sitting at a 75,000 crore market cap. What does it basically do? So, Tube India is basically in the entire manufacturing of all of these major industry parts, right? They're in automotive, railway, construction, mining, engineering. So basically they're an engineering company, and if you see, industrial systems contributes to 31% of their revenue, engineering division 28%, power systems 15%, and they also, quite interestingly, hold 58% stake in CG Power. Right, CG Power is another company that is held by Murugappa Group, and this is also a company that is held by Murugappa Group, right? So they are also a stake in CG Power, which is in the energy domain, 4% in mobility, and it sells bicycles like BSA, Hercules. I mean, these were bikes that I used to ride when I was a kid, right? I don't know how many of you still ride bicycles, but this is what it is. The company also holds 70% stake in Shanti Gears, again a part of Murugappa Group. So as you see, this is a company that holds a lot of stake in different companies, and I'll show you why it is very important as well, right? Because this company has been growing quite significantly. As you see, it's a part of Murugappa Group, and these are the group companies that are a part of it as well. So these are all the different companies that are a part of Murugappa Group. Very interesting plays that are happening with this company. Now, if I had to go deep dive into it, the P ratio is high. Right, 88.7 from a P ratio perspective is high. Even if I look at it from a forward P, if I calculate next 12 months of P ratio, it would be at maybe 60-65. So I would say Tube Investments as of today is high, but as I said, buy on dips. If it starts happening, if it starts falling down, this is something that I would be very happy on, mainly because if you look at the efficiency ratios, ROE and ROCE are wonderful. It is beautiful, right? Now coming down, let's look at the stock price growth, right? Now, if you look at the stock price growth in the last 1 year, it has gone from 3691 to almost 3921. Now, you'll be like, Shashank, it has given no returns almost in the last one year. Almost it has given maybe 10% returns, right? 3600 to 3900, maybe 7 to 10% return, which is not great. But if I zoom out of this company and show you a 3-year horizon, now you will understand why this company is looking very interesting. If you go through a 5-year horizon, even if you go behind the COVID run as well, you will see that this company has been a compounder. If you go even further away for the 10-year horizon, even before COVID, this company has always kept giving returns, and we will understand more from the financials. Now, if I have to come into the financials from a profit and loss statement, this is how the profit and loss statement basically looks like, right? So if you look at the last 5-6 years of revenue, there has been growth, excluding COVID here, there has been growth every single year, right? The margins have remained intact at 11-12%. And if you look at the PAT has significantly gone up over a period of time, right? If you ignore the TTM, because that is just trailing 12 months, the PAT has gone up quite significantly from 16 to 62, and it gives you a good amount of dividend as well. And if you just look at the stock price growth rate, 5 years, it has given a 64% compounded annual growth rate, mainly because their 5-year revenue or sales has also gone up by 24%. So this company has significantly done well in the past. And as I said, this is more of a long-term compounder, and it follows this trend. It is in a beautiful channel right now called the upward channel. And whenever it starts hitting the lower channel, which is either below the 50-day moving average, this yellow line, or towards the gray line, which is 200-day moving average, this looks very interesting, right? If you look at the reserves, they have 5,000 crores of reserves. So they have no solvency issues that are there, right? If you come down and look at the promoter holding, 45% of the holding is still with promoter, 27% is with FIIs, DIIs hold 15%, basically a lot of mutual funds hold this company as well, and only 11% is with the general public. Now, if we look at the notes, just to quickly understand what is the summary of their entire thing. So they have free cash flow of 42 crores down from 97 crores. ROIC, which is return on invested capital, annualized is 47% down from 56%. As you see, that is why they have not done really well in the past, in the last 1 year. But from a long-term horizon and a long-term perspective, because they're operating across multiple different verticals, they have been doing really well, and they will continue to do well, because if India grows, this company should grow. That is basically the 1:1 comparison of this company, right? So this looks very interesting from a play. And if you look at the other companies that he has taken, so whenever he has taken another company, if those companies start going up, this guy also will start going up, because inherent intrinsic value is there. So if I am holding a stake in another company and that goes up, automatically that stake has some value in my company. Yes, there is a holding company discount, but then you see how it starts going up as well, right? And Shanti Gears is the other company. This is a smaller company that they have, a gear company, and this is something that has also been growing quite significantly. So Murugappa Group has been doing a lot of plays in the market, so that is something I want to touch upon. Now the second company I want to look at, right, this is again very interesting, is wealth management. Now if the interest rate cuts happen in India, I mean in US, and then it happens in India, the wealth in people's hand will grow. The more wealth comes up in India, AMC companies, which is asset management companies, start doing really well. So for example, your Nuvama, Motilal Oswal, and your Anand Rathi type of companies start doing really well. Now if you look at wealth management as a whole, there are three very good wealth management companies. One is Nuvama, one is, I would say, Motilal Oswal, and then we have Anand Rathi, right? So if I had to open all three together, yes, the third company is Anand Rathi. So Anand Rathi, yes, I like Anand Rathi a lot, right? But it is at 66p, so it is quite high, and as you can see, it is saturated on this P, so it is waiting for the earnings to catch up, and even from a market cap to sales perspective, it is high. Motilal, on the other hand, looks very undervalued at 15p. 15p is today. That means if I calculate forward P of 1 year, it will be less than 15, right? But if you look at Motilal Oswal, they have also been growing. So as you see, AMC companies have been growing a lot. But again, Motilal Oswal, if you look at it, they don't have a very good track record, because in the past they have never given returns. Now they have started doing something really well. So that is the only key risk factor I would say in Motilal Oswal. But right now they are making significant amount of cash in bank, because this is a company that does free cash flow a lot, right? So you can see the stock price growth, you can see the compounded sales growth. So this is like a very slow long-term game. I think it should do really well, right? So I would take a bet, if you ask me, either on Nuvama or Motilal. Anand Rathi is slightly overvalued at this point, but both of these guys are also looking very interesting. And as you see, the revenue of these companies only grows as long as India's revenue keeps growing. This company also keeps growing. The third company that we will look at is in the pharma space, which has recently done a demerger. Okay, it is called Jubilant Pharmova. Now this is again a very interesting company, right? Why? Because they are into multiple different things. So I don't know how many of you know this. I will show you basically in their investor presentation. They are into something called radio pharma, and they are one of the biggest players in the world. Like in US, if you look at it, the company is the third radio pharma manufacturer in US and has number 2 in network with 46 radio pharmacies. So basically they sell all of these products there. Their margins are very less on this, right? But when they sell it there, they start making very significant amount of money. They have taken some time to do a turnaround. This is a very long-term play. They have a very strong, what do you call that, management. And if you have a strong management, your chances of doing really well is also good. They're also in the right sectors, and their moat is that they're sitting at the top position right now. So they are into radio pharma, CDMO, generics, drug discovery, all of these things they have already there. And if you look at this company, all of these segments, whatever I've shown you right now, are in the growing segments of the pharma game. So this is something that will be very interesting to look at. 69p, very bad ROE and ROC, but let's not come to that. You see how the growth rate of the chart is happening. As you see, this company recently did a demerger. It did fall down. I'll show you why it fell down as well. It did fall down because the profit and loss of this company was showing negative for 2 years, and now, 1 year, and then now it has started doing a revival, right? But the revival of last year was mainly because of an exceptional item of 396 crore in the last quarter. So I'm going to wait for another quarter to check. But if you see the stats, they have started the profitability journey again. So I would just wait. I would take this as a one-off. I would definitely wait and see what is going to happen with this company. But from a stronghold perspective and looking at pharma doing really well in the future, I think this company can, do really well. If you look at the PPT that is inside this company, let's quickly look at that as well. So Radio Pharma gets 48% of their revenue, CDMOs around 19, that is number 1 and number 2, and CRDMO, which is contract research, is around 14, right? So this is very interesting. So Radio Pharmaceuticals, if you see, their EBITDA margins are at around 48. This is Radio Pharmaceuticals, okay, not pharmacy. I'll show you the other one as well. That Radio Pharmacy is over here below. So here you see that the growth rate is there, and they're making 48% EBITDA margins on this, which is great from a margins perspective. Now, if you look at the radio pharmacy market, they're mostly in the East Coast compared to the West Coast, but they are one of the biggest players in US. So that is something that is like a key advantage they have, and they're also planning to invest $50 million to make them even more better and to attack every single place in that place, right? So new PET radiopharmaceuticals to be fully operational by 2028, and they're funding everything through internal accruals and long-term credit debt. So if you look at the margins, as I said, the margins are very low because they're doing a product sale here. So they have 570 crores of sales, and their EBITDA is only 13 crores. So this has to improve. If this improves, they will do really well because this is majority of their revenue. But this company will grow over time in future, and the management is very strong. So only looking at these kind of factors of Jubilant Pharmova, I feel this might do really well in the future, right? So I'm not going to go too deep into it so that you can have a read by yourself. This is slightly riskier than the other two companies that I showed you, which is in the wealth management space, and the other one which was Tube Investments. So this is in the slightly more risky category, but I feel when the market starts falling or correcting, there are some go-to stocks that I want to go to just start doubling down. And I know for a fact some of them will do well, some of them will not do well, but these are very long-term plays. So 4, 5, 6, 7 years into the future, if you look at it from that perspective, I feel that these companies should do a good job. So guys, I hope you enjoyed this video, and if you did, click on the like button and also share this with your friends, and also follow me. And if you want more deep insights about stock market, stock picking, what are the momentum plays that are happening, do follow the YouTube community channel, because I keep putting regular updates, at least 2 posts every week on what is happening with the entire market, right? So this is me, Shashank Udupa, signing off. Take care. See you guys. Bye.